Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 8th of November. I'm Daniel Lam, your host for the podcast. I'm usually the first person in the office. As a result, I've been able to glance through the newspapers that were delivered to the office earlier in the mornings. Over the last few days, the headlines of the local Chinese newspapers had become much more positive as the Hang Seng Index showed some signs of life. Are Hong Kong China equities edging higher? Let's look at EM equities in general. They have remained unloved, especially relative to the S&P 500 index. The MSCI EM Equity Index is down around 2% year-to-date versus the S&P 500's gain of roughly 13%. But the cumulative underperformance of EM versus the S&P 500 since January 2011 now stands at 145%, excluding dividends. If US Treasury yields and the US dollar have truly peaked, leading to an improvement in risk sentiment, then historically this had been associated with EM outperformance. Now, of course, US exceptionalism has been dominating throughout 2023, but the end of the FOMC rate hiking cycle may signal a shift in the EM outlook. So far, last week's dovish events in the US saw a strong reaction across the EM equity space, which is currently uncrowded, but positioning shows continued investor skepticism around China's recovery. It seems that global equity investors prefer expressing an EM rebound via China proxies, such as Korea, over Chinese equities themselves. Well, the key data to watch in China this week would be the CPI and PPI data that will come out this Thursday. Now, there had been some signs of stabilization in the most recent sets of Chinese data, and the latest e-commerce high-frequency CPI data shows minor improvements from September. Now, these improvements, plus the fact that the Chinese government was willing to expand its fiscal deficit, which we touched upon in our podcast back last month, had lent support to Chinese equities. So, for example, the Hang Seng Index managed to build a base around the 17,000 area and is currently attempting to test the critical 18,300 resistance level. But still, for a more sustained rally and a return of confidence in Chinese assets, ongoing and significant government policy support is necessary. Therefore, at this stage, our preference still lies in US equities over Chinese equities and also over Asia ex-Japan equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.